How do you see the market set up, and why have we seen such big volatile swings so far this week?
Well, it comes back down to the larger structures that we discussed last time you and I spoke, and we had rising wedge patterns on a lot of these charts, and they basically were repeating what we saw in 2018. And then these wedges just broke, and they broke on the news that the China trade deal is either delayed or possibly in trouble. So we had a massive run off of the December lows. We again became overbought. We again saw markets rise on weakening participation. This is really important because we saw the S&P make a new high and we saw the NASDAQ 100 make a new high, but we didn't see new highs in small caps, in banks, and larger indices such as the NYSE or the Dow. So now what we see this week is actually markets dropping back to the January 2018 high. So basically markets have gone nowhere in this entire time frame, yet we've seen these wide price swings over the last 15 months. So we had big up, we had big down, big up, big down. And that's not a sign of a stable, calm bull market. There's a lot of volatility in the price action. So now what we see here with this China deal is actually quite critical because markets had priced in that a China deal would take place. And now that that's on the fence, there's a lot of uncertainty because obviously earnings estimates for Q4 later this year are assuming that a China deal is in place. And if that does not happen, then these earnings estimates may be widely overstated.
If we can get, the point I was trying to make on the telestrader was that if we can get back to positive for the week, if we can pretend that Monday, in some ways, Sven, never happened. Doesn't look like we'll get there now based on futures, but you never know. If we can do it, does that say anything technically about the market?
Well, first let me say that Fridays this year have been incredible. I keep calling them magic risk-free Fridays. Over 80% of Fridays have been solidly up this year. So you never know what happens today. We may still see that magic rise up. To me, from a technical perspective, the fact that the previous highs that we just made on S&P and NDX have rejected, that kind of puts you at risk of maybe having some sort of larger topping pattern in markets. So markets really need to first recapture 2,900, and then they ultimately need to make new highs. Otherwise, you've got these big patterns out there that show lower highs in some of the indices and failed highs on some of the other ones.
80% of Fridays have been higher this year? I mean, is that just, why? Just random but interesting.
No, yeah. I mean, look, it's fascinating. I keep calling it Magic Risk-Free Friday on Twitter. It's a running joke among traders because even last week we were initially down significantly last Friday, and then had this massive ramp up. Now, obviously, that ramp failed because we saw new lows on Monday, but still, you go back every week here in the last couple of months, and every Friday is up. Maybe it'll change today. We'll see.
Well, we will see. Futures are down right at about 120 on the Dow, but it's very, very early. Sven, I want to switch gears. Yesterday, we had a guest on set, Peter Bookfire, highlighted that credit card interest rates have never been higher. In fact, they're averaging 17%, according to the Federal Reserve. I kind of called it semi-jokingly the real tariff issue on the consumer. You chimed in. Your chart was even more interesting, that interest rates have gone down, down, down the last number of years, but individual payments, the blue line we're showing, have gone up, up, up. Does that just tell you that the American consumer is just addicted to debt? What are we looking at here?
Well, firstly, you're making a very good point. Debt has been increasing on the consumer during this entire cycle. In fact, the overall household debt is now on the consumer is over $1 trillion higher than it was at the peak of 2007. And revolving credit card debt has also increased significantly from $857 billion in 2012 to now over $1 trillion. So debt levels are increasing. But what's fascinating is that when the Federal Reserve started raising rates at the end of 2015, credit card rates really jumped higher significantly, especially in the last couple of years. They were around 13% in 2015 and now 17%. That is a double effect, and it's causing a massive increase in personal interest payments on the consumer. So if your average credit card levels about $7,500. If you're now paying 17% interest rate on those, your payment is about $1,300 a year. And that's obviously curbing into your disposable income on the average family. So, you know, as much as talk there is no inflation, well, there's real inflation as far as consumer debt obligations are concerned here on credit cards.
Yeah, it's truly an incredible story that maybe is not getting a whole lot of attention. Sven Henrich, we appreciate your time. We'll see if today is one of those magic risk-free Fridays you've talked about. Future's not indicating, but you never know.